Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video, I'm going to share with you guys 6 companies that have a safe dividend, currently fairly valued or undervalued at the moment. When you look around the market right now, it's very difficult to find companies that are still undervalued, but there are basically opportunities in the market. So I'm going to do 6 in this video, and the next video I've got another 5 that are dividend paying companies, and then I have another 5 that are non-dividend paying companies. So I've got 3 almost back-to-back videos, inshallah, that I want to share with you guys that have almost 16 different companies that are still undervalued or fairly valued right now. And what I'm going to talk about today is 6 companies that have a safe dividend. What I mean by that is, as a dividend investor, if you are closer to retirement, what you want is companies that increase that dividend year after year, okay, without having to do anything. You don't need to do anything. They will increase that dividend for you, and your income increases every single year. What you don't want is relying on that dividend to pay off your mortgage, this and that, and you end up having companies that are cutting their dividends. That's not something we want. So what I'm going to do now is I'm going to share with you guys 6 companies that have safe dividends right now. Things can change in the move into the future, but right now they have safe dividends and they are either undervalued or fairly valued. So let's get started. But before we do that, you know the drill. It will be absolutely wonderful for you to just press that like button, subscribe to the channel, open that notification bell so you don't miss anything when we post, inshallah. The other thing I would ask you guys to do is if you can join us in the Patreon account, whether just to support the channel and you get access to all of these things. Also, basically by paying £4.50 a month moving forward, you get access to all the buys, all the sales that I'm making, frequent and portfolio update. Every single day, if I buy or sell, I actually share it straight away on the Discord. Okay, the ETF trackers is there. You've got the Sharia compliant invested ebook, and so on. So inshallah, it will be really wonderful for you to get hold of these things as well. Of course, it supports the channel, inshallah. It keeps us going. Now let's get started. As usual, like I said, we're focusing on the yellows today. So the safety and the Morningstar valuation, that is basically fairly valued or undervalued at the moment. And the first company we're going to talk about today is one that just reported this week, and that's Hershey Company. The company has reported its earnings, and the earnings were actually not great. Okay, if I can show you very quickly. So revenue side of it, it was just a little bit of decline, but year on year it was still up by 0.4, so nothing huge to worry about. And of course they beat the top line, which is absolutely fine. The reason that basically the company has reported lower is because of the high cocoa prices, which will eat into the basically to the profit. So that's probably the reason why the stock was down. But it's great for me because I own the company in my portfolio, and it's good for me because I have not finished buying it yet. Right now it's gone up a little bit. I'm actually up a tiny bit, but it will be really nice to see a pullback so I can actually buy more. Once I finish, I don't care, then it can go to the moon if it needs to. It has a market cap right now of almost $14 billion. It has a wide economic mode. Price right now is $199 per share. Dividend yield of 2.6, which is very healthy, very good. And that dividend, they've actually increased it, just this basically a report. So in this report on the 8th of January right now, February, they've said basically increasing it by 15%, which is absolutely wonderful. That's where that 15% comes from. The 5-year growth rate is basically 9%. They have increased that dividend for 13 years in a row, which is quite nice. So I hope they continue this for the next 30 years. The annual payout right now is $5.46. Safety 93%. The highest any company can get is 99%. Profit margin right now is about 17%, return on equity 50%, return on invested capital of 25%. So in terms of business side and profitability side of it, the company is actually very healthy. Free cash of $1.6 billion. Total return of, based in the last 10 years, is about 8%. I love free cash flow because that's the money the company can use to buy back their own shares, to acquire other companies, so they can use that money to buy other businesses. They can pay off any debt, pay dividends, and so on. So there's a lot of things they do with free cash flow, and it's quite nice to see that. I hate when companies have a negative free cash flow, and I've got air product and chemicals in that situation. now, but I'm hoping that in the next year or so that will change, inshallah. Growth estimate right now for the next year is 3.3, and then growth estimate for the next 5 years is about 7%. This might change in the next couple of days once the earnings reports have settled. Maybe Monday, Tuesday next week we'll have a upgrade, downgrade, see what happens, and we'll take it from there. But fairly valued right now, $197 per share is where they think the price should be. The next company is EOG Resources. This is an oil company, energy company, 65 billion market cap. It has a narrow economic moat, $112 per share, almost a 5% in terms of dividend yield. Normally these companies do have a higher dividend yields, so it is quite normal to see that. Payout ratio is only 28%. Latest increase was 10%. 5-year growth rate of 36%. Dividend basically streak of 5 years. So they have increased that the 5 years. In the last 5 years, annual payout right now we're looking at $3.64. Safety 82%, which is quite nice. Profit margin 33%, return on equity 30%, and return on invested capital of 27%. Now they have a free cash flow right now, $5.6 billion, but these companies, oil companies, do have a bit of cash because they are capital intense companies. They use a lot of that cash to do all sorts of things. So total return in the last 10 years we're looking at about 5%. Growth estimate for the next year is about 3%, and then after that it's a 1% decline moving forward. That could easily change if the oil prices change and all of that stuff. A lot of commodity companies basically suffer from this kind of thing when they, the commodity, the underlying assets is actually not doing as well as they should do. 15% discount right now, $132 per share is where they think the price should be. The next one is a company that I own in the portfolio. I think it's reporting next week or week after, and that company is METRONIC, $116 per share. Wide economic moat, $85 per share right now. Dividend yield over 3%, which is really nice. The payout ratio right now is 52%. Latest increase 1.5. 5-year growth rate of 8%. Dividend streak of 45 years in a row. Annual payout right now is $2.76. Safety of 99%. So nothing to worry about. Profit margin, return on equity, and return on invested capital is kind of decent. Not a lot. Nothing to shout out. Free cash flow right now, $4 billion. Total return in the last 10 years, about 7%. 6% growth next year, and then about 3% after that. 22% discount right now, $112 per share is where they think the price is at. Now we're midway through. I would absolutely love you to press that like button if you haven't done already, because it really helps the channel. Next company we're looking at is Public Storage, another one that I have in my portfolio. $49.4 billion company, is one of the REITs, real estate investment trust. It has no moat right now. Price is $283 per share. Dividend yield over 4%. Payout ratio is 76%. 50% latest increase, 0% in the increase over the last 5 years in terms of paying that dividend, but increasing that dividend is 0. Annual payout right now $12, and safety 96%. Profit margin, return on equity, and return on invested capital, they're all decent. $2.7 billion of free cash flow, 9% basically in the last 10 years. Total return is at 9%. Growth estimate next year, by the way, this isn't basically decent for a REIT, okay? Just the companies don't actually, price wise, they don't go up as much, but with the dividend, of course, 9% is decent. Of course you want 10% or more every single year into your total money, but 9% actually is fine. Growth estimate next year is about -3%. Then growth estimate for the next 5 years -20%. That can easily change if the interest rates come down. Things slightly get better in terms of that side of things, because REITs benefit from lower and of course interest rates and so on. Morningstar valuation 11% discounted, $317 per share is where the price should be according to Morningstar. Next one is Genuine Parts Corporation. This company has 20 billion market cap, narrow economic moat, $142 per share right now. $2.67% of dividend yield. Payout ratio 41% only, which is quite nice. Latest increase was 6%. 5-year growth rate of 6%. 66 years of increase in that dividend. So this is a dividend king. This one here is a dividend aristocrat, 25 years or more. This one is a dividend king, 50 plus years. Annual payout right now $3.80. Safety 80%. Profit margin of 5%. Return on equity 31%, almost 32%. 20%, 19%, 20% of return on invested capital, and $859 million dollars right now in the bank for free cash flow. Total return in the last 10 years is 8%. Growth estimate next year is about 6%. Growth estimate next 5 years is 9%, and 11% discounted right now. $161 per share is where the price should be according to Morningstar, and price right now is $142 per share. And finally, Applied Materials is the next company, 142 billion market cap. It has a wide economic moat. Prices right now $181 per share. Dividend yield of 0.6. In terms of increase recently is 15%. The last 10 basically the payout ratio of 15%. Latest increase was 23%. 5-year growth rate of 12%, and 6 years of increasing that dividend. $1.28 is what you will get. 86%. Now when you look at this here, 80% almost safety, which is quite nice. Okay, normally what happens is if it's below 60 it's not safe. Anything below above 60 is a safe. I think it's about 80 or whatever it is a very safe. I can't remember now, but these, to me, these are very decent. Of course, profit margin 26%, return on equity 48%, return on invested capital of 34%, $7.5 billion free cash flow right now. Total return in the last 10 years, 26%, 17%, expected to grow about 17%, then 15%. This is really interesting. When I did this first, I was like, okay, I need to do a little bit more research on this company. So I will be doing that, inshallah. If you're interested in that, just let me know in the comment section. But this seems really interesting because when you look at all these metrics, it's actually quite nice. They have excellent free cash flow. They've returned quite a bit in the last 10 years. They're expecting to grow their earnings nicely and fairly valued right now, only $152 per share. But remember, this is one of the semiconductor companies. It's a very cyclical business, so I need to do a little bit more digging on this company. But really interesting. So there you have it. All of these companies have excellent dividend in terms of safety, and they also are basically seem either discounted right now or almost there. And when we look at the from Sharia compliance side of things, absolutely no issues. Majority of these companies have no issues. The only one I would say METRONIC right now in terms of interest bearing debt is about 27%. Other than that, the rest of them are absolutely fine. There you have it. That's the 6th company I wanted to share with you guys today. If you like this type of content, it takes a lot of time to put these things together. Full time with the family. I'm trying my best, inshallah, to share my journey with you guys and to just for entertainment, to give you this type of videos. So at least then you can go away and do a little bit more research. Like I said, after I've done this, I'm like, this company seems interesting. I'm going to go away and do my research, inshallah, and I'll share that with you guys. You might do exactly the same with Hershey or any other companies, like I said in the beginning of the video. I hope you enjoyed the content. Like I said, I've got 2 more videos based on Seeking Alpha's quant system. 5 that are basically undervalued at the moment that pay dividends, and 5 that are not paying dividends that are also undervalued. So that's another 10 companies coming, inshallah, your way in the next 24 hours, 48 hours, inshallah. Have a wonderful day. Assalamu Alaikum.